Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The grain markets have reached critical levels for us, and this week we were looking for a top to potentially set in for both corn and soybean. September corn now finds itself at resistance near the 370 to 375 mark, much of what we had anticipated, especially since we have our one-by-one downside angle right above the market. The market had experienced some very strong downside momentum and has since crossed above our zero line and has now made a marginal break above that level. If this market is able to carry through with additional momentum, we could see a potential test near the 380 number, but for now we're looking for the market to potentially turn over, especially since we have now entered into our turnover zone. Weather reports have been the greatest factor as of late that has helped corn to find a bit of support, but in the event that this weather turns beneficial for corn, we would quickly soon see a nice move to the downside. So for now, we sit at a very critical level as to whether or not this market is at true resistance. In our recent newsletter, we discussed how volatility-based resistance and our volatility band near the 373 to 380 mark was looking to be potential resistance, and that's exactly what we are now finding. The market made its way up right up to our band and has since been inside of a sideways consolidation. We believe that this resistance should hold up well, especially going into next week, and after the next 5 to 6 trading days, we would look for a potential move to the downside outside of some type of news event changing the market higher. As would be expected, December corn is going to look very similar. In fact, the December corn contract is right up against our one-by-one angle, and in a similar fashion, we would look for a shift to the downside. The momentum for December corn was very strong previously as it made its way down. We have since moved above the zero line, and the market now has given us a marginal bump. If this momentum is actually able to carry through, what we would then find is instead of the market turning down is that this would become a continuation pattern for a next leg up in this market. So the weather over the next week or so is going to be very key in terms of determining the direction in which corn looks to go. Cycles wise, we still anticipate that the market looks to go down. Similar to that of the September contract, we can see that the December contract is also right up against volatility-based resistance, with its band sitting between 385 and 393. For soybean, we can see where it reached our volatility-based resistance band, as well as our key resistance overhead at 907.5. This had previously been support, but once the market was able to break it, it is common to discover that previous support will become future resistance. Notice then that once the market broke through, we found resistance here, it dropped, came back up, and once again is operating as resistance. This 907.5 number is going to be very key for the September contract. We also have our August 3rd time factor coming in, with the market moving up very close to that date, giving us a marginal move to the downside. But what we would look for here potentially is if the market were to give us a lower high below the 907.5 number, we would anticipate a very precipitous drop moving forward. Part of why we believe this is because of the supply narrative that surrounds soybean currently. Despite all the news around the tariff wars, etc., we've seen that corn has actually been able to hold up marginally well, in part because China is not a huge buyer of corn, but is a significant buyer of soybean. But the reality of the supply narrative tells us that soybean is going to have a very difficult time being able to move to the upside, and it remains to be seen whether or not it's going to continue higher. The September contract moved right up into volatility-based resistance from the 900 to 915 range, and you can see the way in which it turned down from resistance. From here again, we're looking for the market to respond to this current time factor zone that it has entered into, and from here we would anticipate that the market could potentially reach lower into the end of the time zone, give us another bounce, and then look to perhaps move down again. At this juncture, the concern now for soybean is that we can potentially see a retest of previous lows near 830 and perhaps even go a little bit lower and test something close to 800. Again, right now the market is up against key resistance. In addition to being at key resistance, we also have one standard deviation below the point of control sitting at 930. And so this area does look to be very significant for soybean. And again, the pattern that we'd be looking for is for the market to make a drop and potentially make a lower high. And that lower high would be a potential entry zone for the next leg down that looks to retest that 830 area. Our sentiment for September wheat was that it had a very good chance of retesting the previous high near 570, with the potential of advancing another 90 degrees above to test the 595 number. That's exactly what we got from the market on Thursday, and now we can finally see the market giving us a bit of a pullback after having reached a significant target area that we've been looking for quite some time. The narrative that surrounds wheat has been the discussion about how the crops worldwide have been lower than anticipated, and in doing so, it's given quite a bit of a boost to the wheat contract. Now that wheat has reached resistance, we would anticipate that the market could consolidate from here, and as would be expected, we're seeing a bit of profit taking after having made a significant run to the upside. Key levels of potential support then that we'd be looking for below is if the market were to go down would be somewhere in the neighborhood of 532, which is one standard deviation above the point of control. And in the event that the market's able to break through there, we'd be looking at the 180 degree mark of 524. And finally, with the potential of coming down somewhere near 500, which is our point of control level. Wheat has been trading very much in concert with our anticipated cycle projections, and from here we are looking for a major correction to set in now that it has reached our price projections. The high that was made on Thursday, which was a huge reversal, coincidentally hit right up against volatility-based resistance in conjunction with that 90 degree factor of 595, and as would be anticipated upon reaching key resistance, the markets do often respond. From here, again, we're looking for the market to continue trailing down. We do have a key support level that we had discussed previously at 513. Once this market was able to clear this area and then find support, that was key for this huge move up that we did find. And as we continue to monitor, we would look for that 513 number to again play a very significant role in this September contract in the event of a major correction to the downside. The US dollar has been inside of a very huge consolidation, trading between the $94 mark for support downside and 95 and change, and almost 96 overhead as far as resistance is concerned. This market has been inside of volatility-based resistance, and the way in which the US dollar is trading is consistent for the patterns that we would expect once we take a look at what the longer-term weekly chart looks like. This indecision that we're seeing in part is because of the U.S. and its negotiations across the board, with the administration recently suggesting that the dollar may be a bit too strong. We're also seeing foreign nations make adjustments to their currencies as well, and as those negotiations go back and forth, it puts the U.S. dollar very much in a conundrum in terms of the direction in which it wants to go. The weekly chart really says everything that we want to see for now, because the market has reached up into volatility-based resistance, and we would look for about 5 to 8 trading weeks for the market to consolidate inside of that volatility-based resistance, or 5 to 8 bars, before being able to decisively decide on its next direction. Upon clearing 96, we would anticipate that the US dollar would find some very good strength, and if it's not able to clear 96, then we would look for downside support midway inside of the range that we see here around 92. But if it breaks 92, a retest of previous lows in the neighborhood of 88 to 90 is probable. So for now, we want to see the way in which it responds coming out of this recent consolidation phase that it's been in for the past several weeks. And after about 8 weeks of consolidation, we would then look for some follow through in either direction. Thank you so much for joining us for our regular market update, and look forward to touching base with you again next time.